and welcome to the first quarter of 2024 Outlook. I'm Keith Sprower, Chief Investment Officer here at Global Wealth Advisors. Given that we just came through the year end, I want to start with the performance quilt or asset returns for 2023. We now have 16 years of data, 15 years if you remove the worst year of the Great Financial Crisis, which was 2008. The 2023 returns are in the far right column. It was a surprisingly good year in the markets. Coming into 2023, most strategists had a recession in mind, or at very best muted returns across the asset classes. You can see from the 2023 data that many areas had double-digit returns, with large cap being up about 26%, and even fixed income, which looked to be having its third straight year of negative returns, rallied substantially in the fourth quarter, pushing returns back to positive. The worst performer for the year was commodities, and this was due to slowing global demand and inflationary pressures subsiding. Keep in mind, though, in 2022, it was the best performer by far. Cash, on the other hand, returned about 5% in 2023, which is very high historically, as you can see from the chart. But a 60% equity, 40% fixed income portfolio, the white connected squares, did much better. This brings up a point around when to exit cash and go into the broader market. I feel we're moving into a more normalized economic environment. So even though cash continues to have a very reasonable yield, I don't believe you should wait for the perfect time to be invested. As I've done in the past, I'm going to start with the items that have been driving the markets. And I still feel the best place to start is with the Federal Reserve. The last Fed meeting of 2023 was in mid-December, and they put out their projections for the Fed funds target rate. That's the overnight bank lending rate going into the future. Now, I'll be the first one to question the efficacy of the Federal Reserve, though I do feel that they help more than they hurt. But since they started hiking in March of 22, they have stayed close to their talking points, meaning if they said they may pause depending on data, they did. And they say they're going to cut this year unless they see a substantial turnaround in inflation. I feel they will. These projections are what we are looking at in the graphic on the left, each dot being a voting member's view. These views can be very spread out or influenced by outliers, so they use the median data point for year-end projections. You can see that the Fed themselves are expecting to cut by 75 basis points or 0.75% over the course of 2024, with an expectation of continuing to do so over the next few years until we get to about a 2.5% longer run Fed funds rate. So that's what the Federal Reserve is willing to say or put out there. What the market has built in for 2024 is on the right. This is telling us what the market is expecting by the last Fed meeting in December of 2024. As a reminder, this comes from probabilities in the futures market. It's showing that there is a 32% chance of a 150 basis point cut and a 38% chance that they will cut 1.75%. Now, these probabilities change every day, particularly as more data comes in. But if the Fed cuts 0.25 point increments, they would need to cut 6 times to get a total cut of 1.5%. They only meet 8 times a year, so they would need to start cutting late April and continue to cut for the rest of the year. Depending on the economic data and the time it takes for them to digest the data, I would expect them to cut 0.25 point at the last 4 meetings of the year for a total of 100 basis points or 1% of cuts in 2024. That in itself would do a great deal to normalize the yield curve. With a current overnight rate of 5.25 and a 10-year treasury around 4%, that inversion of yields has to change at some point. And I don't expect the treasury to move up past 5.25% on the 10-year, so that would mean the short rate would have to come down. One of the reasons there are so many interest rate cuts built into the market is because there's an expectation that growth will slow considerably in 2024. And we may see that started in the fourth quarter of 2023 when that data comes out. Recall that GDP is driven by spending. Consumer spending is the largest portion, but there's also government spending and corporate spending as well. The two charts on this slide show gross domestic product in the recent past and forecasted into the future. Quarterly numbers, which is how the GDP is reported, are on the left and annual numbers are on the right. You can see with the quarterly data that the numbers are muted with the exception of the third quarter. That has a lot to do with companies replenishing their inventories, some imports data, and an increase in consumer spending. But the expectation is that consumer spending will fall, government spending will stay approximately the same, and corporate spending will drop from the current levels due to the higher cost of capital to finance inventories. When we review the annual GDP numbers, the expectation is that this year we'll see minimal growth, but staying positive, and then level back out to around 2% growth in the years to come. If we do in fact get the Q4 2023 number and the Q1 2024 number that are being projected, you can see why the Federal Reserve would want to begin cutting rates and not just let the economy possibly drift into negative GDP growth, in other words, into a recession. There are only a few things in my mind that could get the Federal Reserve to consider hiking again in the near term, keeping in mind they paused for the last 4 meetings or over the last 6 months. The biggest would be an energy scare, particularly an extended spike in the price of oil. But looking at this inflation data, we're settling in at these lower rates on both CPI and PCE. They're still not as low as the Fed would like, but if the economy starts to slow and spending starts to slow, prices will come down. So it doesn't bother me much that we've hit this 3% inflation rate wall. I wouldn't expect to keep dropping at the same rate as we were over the past year. Over time, we'll get to where we need to be. It's a very similar story in the interest rate market, where we saw a substantial rally at the end of 2023. This graph shows the 10-year Treasury yield from the third week in October of 23 until recently. Recall that as bond prices go up, their yields declined. This reversal of yields, and it may not look so drastic from this graph, but it's going from over a 5% on the 10-year in October to we got as low as a 3.85% in December, well over a 1% drop in the interest rate. This roughly means the 10-year Treasury returned 9 or 10% in an 8-week period, which is remarkable. It's bounced back a bit over the 4% yield level, but I feel the volatility we've seen in this part of the market over the last few years should slow, and as we see the Federal Reserve moving closer to cutting interest rates, that certain treasuries will perform well. Shorter dated bonds will likely see more of a drop in yield than longer maturing bonds. Given the Fed will unlikely cut all the way back down to zero, rates should normalize to a certain extent. This means we can start thinking about our fixed income assets for long-term income generation. Ideally, we want the economy to moderate in the areas where it's been strong and to pick up in areas that it hasn't, to get a happy medium in the economy getting back to trend growth. One of the big and continued concerns around the economy has been how tight the labor markets have been. To get to a softer landing, we need the unemployment rate to drift higher to above 4% and average hourly earnings growth to drop and stay below 4%. We're seeing this now given certain trajectories. The idea or goal is to get out of this wage price spiral, which is inflation causing prices to increase, causing workers to ask for more money, causing companies to have to increase prices to cover that cost, causing workers to ask for more money, and so on. And when you're at full employment, there isn't much that a company can do to get out of it. Inflation coming down is the first step in reversing this. The chart on the left is the monthly unemployment rate during 2023. You can see that it bounced around the first half of the year and has been drifting towards that 4% I mentioned. It shows that we may be moving to a trend of softer employment. We can also see on the right-hand side that the year-over-year hourly earnings have dropped and are stalled at around 4%. As we move lower in the overall inflation rate, somewhere closer to that 2%, it should cause wage growth to move lower as well. Another sign of a softer versus harder landing is that corporate earnings are expected to be reasonable through 2024. Analyst projections are on the left. Recall that the balancing act is softening employment, wages, and earnings while remaining strong enough to support a growing economy, i.e. growth without high inflation. The chart on the left is showing average earnings per share of the S&P 500 companies. As we've discussed in the past, this is one component of a two-component formula used by many to predict stock market returns. The other component is the PE multiple, or just the multiple. If the average multiple is, say, 18, and the earnings are expected to be $265 a share, the S&P 500 should be around 47.70. Currently, we're at around 48.20 on the S&P 500, so that would mean a decline in the market. If earnings were as high as this chart shows at $275 a share and you had a multiple of, say, 19.5 times, the S&P would get to a level of 5,362, much higher than we are today. Equities did well in 2023 in part due to stronger earnings than expected. As we've discussed in the past, the consumer makes up 2/3 of GDP. And GDP, in my view, is really what matters in the big picture because it's telling us what all the goods and services have done for the quarter or for the year. As you can see by these graphs, the consumer is coming under some pressure as these higher rates have moved through the system. Household debt on the top left is increasing as people have gone through their savings to keep up their standard of living. Auto and credit card delinquencies on the bottom left have risen, and although mortgage rates are falling via the graph on the right, they are still well above the very low rates we saw before inflation and rates really began to rise. A 30-year fixed rate recently peaked at around 8% and has drifted back down towards 6.5 to 6.75. But unless we get a major economic issue where rates need to drop substantially, I don't believe we get back to the sub 3% levels we saw a few years ago. I want to spend a little time talking about time and what time does to performance ranges and volatility. Over time, rolling periods, not as much on annual returns necessarily, everything smooths out. And I think this is an interesting graph to make this case. And what we're looking at here is return ranges for stocks in green, bonds in blue, and a portfolio of 60% stocks and 40% bonds into the dark gray there. And it really jumps out to me how looking at returns over a short time period isn't going to tell you about longer term performance. There are just too many variables that are present every year, and rarely are they the same variables every year. And I don't mean things like quarterly earnings calls or high frequency economic data. I mean items that aren't expected, right? As the old adage goes, it's what you don't expect that gets you. This chart shows return data from 1950 to the end of 2023. As you can see, that as you move further out to the right, over longer time periods, the range of returns tightens up and smooths out. The volatility or swings in the returns lessens. And the reason why I bring this up as a reminder is that even though the Magnificent 7 stocks in the S&P 500 last year did very well, and the other 493 stocks only averaged about 8% return, we would expect performance to smooth out. It's also interesting that, as we've said many times, having a diversified portfolio like a 60-40 represented here cuts back on the swings in performance, but doesn't penalize you too much on the performance. This last slide for today is a little bit of a summary of what's slowing the economy and markets down and what's helping us move forward. I left most of the same line items from last quarter with updated notes in italics. And I think it helps to tell the story of things coming back into balance, or what I would consider moving towards economic normalization. And what that means to me is less focus on single economic data points like inflation, or caring about the Federal Reserve minute to minute, and getting back to general economic activity and earnings calls and the like. There are always going to be something on the horizon to be aware of or concerned about. When we look at the headwinds, yes, rates are higher, but they have dropped from their peaks substantially, and they're stabilizing at these kind of new lower levels. And even though the Federal Reserve has given guidance along the way, the path of rate hikes was really unknown. And since we've had a pause, we seem to be more concerned about rate cuts now, and when they will start and how long they'll go for. I always feel better when it looks like we're moving away from a tightening policy and moving towards an easing policy stance. In the quarters to come, this should become a tailwind. The last two headwind bullet points are concerning. We started out globally with the war between Russia and Ukraine. Now we've added Israel and Palestine, or Hamas. And now also in the region, Syria, Iran, Lebanon, and Yemen. And there seems to be a determination to have a conflict between China and Taiwan and the US. We've seen in the past that conflicts can be discounted by the markets pretty quickly, but these particular conflicts could affect energy prices. And with most container ships leaving the area, or not using the shortcut of the Suez Canal and navigating all the way around Africa, time to delivery and costs have been increasing. I'll have a lot more data around the elections as we get closer, but there certainly could be some hiccups and hurdles along the way. On the tailwind side of things, valuations, even with the solid market performance in 2023, there's still plenty of value to be found. As we discussed earlier, many U.S. stocks didn't participate to the extent of some of the growth stocks. Fixed income still has attractive yields, even with lower than the recent cycle highs. One of the items that has made an outlook difficult is the fact that we're in this rolling recession, which, as we discussed, means that if different areas of the economy or industry go into a recession at different times instead of everything happening at once. I don't feel that economic cycles are dead, but they've been dampened because we're more about services in this country now than manufacturing. The economy has also gotten better and more efficient over the years. We talked about settling in. Settling in is people finding a way to continue to spend even though things have become more expensive, not selling them short. So where does this all leave us looking out over the next few months? I would expect some softness in the equity market as growth slows in the economy. That would be in the early part of the year. But as we move closer to the Federal Reserve cutting rates and companies continuing to right-size their staff and their inventories, that back half of the year, equity should do well. Fixed income should be a benefactor of any equity weakness and should also benefit from the lowering of interest rates. Compared to the U.S., countries outside the U.S. are at a different part of their inflation journey, which could mean opportunity if they're following similar patterns. I would expect China and Europe to bottom out and could see more catch-up growth as we move through the year. I recently heard one investment company speaking about the numbers in 2024, 2024, and that they'll stand for a 2% growth, 0% chance of a long recession, 2% inflation, and 4% unemployment rate. I don't know if we'll get to those numbers exactly, but I think we'll get close. From everyone here at Global Wealth Advisors, thanks for watching, and I'll speak with you next quarter.